Welcome to the OrcaBot podcast, your home for precision over prediction in MTF trading.
Welcome to the debate. For anyone just starting out in systematic trading, the first real hurdle is always the same. What is the market's fundamental reality? I mean, what's the ground floor we should be building on?
And that question really sits at a fascinating intersection, doesn't it? It's where this very cold, hard, technical rigor smashes right into human psychology.
Exactly. Our source material lays out this clear dichotomy. On one hand, you have the pure, objective reality of price data. On the other, you have let's say the fragile, subjective framework of the human mind trying to execute a strategy.
So the central question for us today is this. Is the fundamental structure of the market best defined by objective price action, the raw data, or by the internal cognitive structure that interprets and, hopefully, consistently executes on that data?
And I'll be arguing the price is really the sole, sufficient foundation for any effective systematic trading.
And I'm going to argue that relying only on that external data is a recipe for failure. The true foundation, I think, lies in mastering that internal cognitive architecture. I mean, if you have the best map in the world, but your compass is broken, you're still completely lost.
So when we talk about a foundation, we have to talk about what's real. And the model that Richard Dennis pioneered, this highly profitable, systematic trend following, it rests fundamentally on the belief that price is the one unfiltered reality. It's the only signal that matters because it has, in a sense, already absorbed everything else.
That assumes a level of perfect execution that I don't think it exists for a human operator. Price is the result of reality, sure, but it's not the foundation for the individual trader.
Well, look at the sheer volume and speed of information today. I mean, whether a massive hedge fund gets some advanced data, a central bank intervenes, or, a market panic erupts in Asia, every single piece of that information, public, hidden, whatever, is immediately expressed in one singular undeniable thing, the transaction that moves the price.
Mm-hmm.
The pursuit of all this other information, reading economic reports, trying to guess what a central bank will do, it's actively discouraged in these methodologies, and for good reason. It just breeds confusion, not clarity. It adds noise to a signal that is already, complete. For a systematic trader, the structure is beautifully simple. Open, high, low, and close. That's the input, that's the output. The foundation is purely technical data. As Dennis said, price is the reality and intelligence is the appearance.
Okay, I agree completely that price is this perfect, real-time aggregator of all knowledge, of global human action. It contains all the knowledge. But the fatal flaw in the argument is that leap from price aggregates all knowledge to price is the sufficient foundation for your action. It's just not.
How so?
Because that aggregated data is completely neutral until it hits a trader's mind. The reason we can see two different traders using the exact same system get wildly different results, one makes money, the other loses it all, is proof that the real fight isn't with the market. You're competing against your own perception of uncertainty. The market is just an amplifier of your own psychology.
But if the rules are mechanical, if entry, size, and exit are all predetermined, psychology should be irrelevant. You follow the instructions.
Just follow. That's the key, isn't it? Every single tick that moves against your position is neutral data. But the trader instantly assigns meaning to it. And that meaning almost always comes from these deep, irrational fears. Fear of being wrong, fear of losing money, the need for that hit of validation from a quick win. This really brings us to what I'd call the first law of trading psychology. You don't trade the market, you trade your internal state as it interacts with the market. If that internal structure, your beliefs, your relationship with risk, isn't engineered first, the best technical system in the world is going to fail.
Okay, let's ground this in mechanics then. The operational core for this has to be what Eckhart called the North Pole, these pure price-based systems. The moment you introduce subjective judgment, feelings, fundamentals, you're just heading farther south into confusion.
Right.
The key structural inputs are incredibly simple. You measure the open, high, low, and close to find trend strength. For example, the breakout rules in the material, what we could call S1 and S2, are purely mechanical. They're based on measuring price volatility over historical time frames. They require zero knowledge of macroeconomics or even what you're trading. Eckhart used to say, if you're trading soybeans and it starts raining, all that means to me is I should bring an umbrella. Profit comes from buying and selling, period, not from analysis. The structure is just tracking the data points and acting. It's elegant.
That elegance, that reductionism is essential for the system, I grant you that. But the application of it is precisely where the human operator introduces catastrophic error. Mechanical rules are necessary, we both agree, but they only work if the trader's cognitive framework is sound. Otherwise, they're just instantly subject to cognitive distortion. You mentioned structure. Let's talk about the structure of the human mind under pressure. We know from Kahneman's work that we have two systems of thought. System 2 is the slow, analytical, rule-following part. That's the one that builds your S1, S2 rules. But System 1 is fast, emotional, impulsive.
And what happens when price volatility hits?
Adrenaline just flood your system. System 1 takes over. It's screaming, the rules are wrong, ditch the plan, do something. And your rational operator, System 2, it gets fatigued and just shuts down. Your external structure is sound, but the internal one defaults to panic. So the real foundation has to be engineered to keep System 2 awake. And that means training yourself in what I call probabilistic patience. Your biology wants certainty, but your trading requires you to sit comfortably with statistics.
I agree completely that System 1 interference is the single biggest threat, but I frame the solution differently. The price-based structure provides the ultimate defense against this biological default. Mandatory mathematical risk management, it's anchored to volatility, not emotion. Risk isn't some feeling you monitor, it's a mathematical principle defined by N, the average true range.
And N is absolutely a mandatory element of any successful system. It formalizes volatility, no question.
Precisely. The core structural requirement here is measuring N every day and using it to set your position size and your stops. So if you have a $100,000 account and you risk 2% per trade, $2,000, and your stop is at 2N, well, the math dictates the exact number of contracts you can buy. The process is external, it's numerical, it forces you into a state of detachment, it forces you to treat money as just a way to keep score. The structure dictates the behavior, which should make emotional variables irrelevant, provided you stick to the math.
That's the aspirational state. But let's look at how successful professionals actually behave. Yes, they use N as a technical anchor, but they are also constantly monitoring what you might call emotional volatility. The whole mechanical system is designed to create a constant psychological load. If a trader finds themselves, excessively worried, checking their phone constantly, they recognize their emotional variance has spiked, even if N itself hasn't. That emotional volatility is a kind of hidden drawdown. It reduces decision quality. So what do? They reduce their position size. The math might say they can risk 2%, but they'll drop to 1 or even 0.5% until they feel stable again.
But if the external rule is followed, why is that necessary? Isn't adjusting based on a feeling the exact thing we're trying to eliminate?
It's necessary because the mechanical rules only work if the trader avoids these deep human pitfalls rooted in our perception of control. The math is robust, but the mind is fragile. Think about the illusion of control, where a trader thinks that because they understand the market, they can control it. It leads to paralysis. Or even worse, they start averaging down, adding to a losing position, which Dennis rightly called putting your hand back on a hot stove. These are behavioral failures. The technical structure has to rely on an internal one that can take losses without having a meltdown. Otherwise, the math is just useless.
Okay, let's shift from risk to entries and exits. My position here is that the foundation dictates we focus almost entirely on exits, the liquidation criteria, and treat the entry price as, functionally irrelevant. The data supports this. Research shows that if your exit rule is solid, you can have purely random entries and still do surprisingly well. Eckhart used to challenge his students to trade as if they didn't even know their entry price. The logic is simple. Markets in motion tend to stay in motion. You have to act when the signal appears regardless of whether the price feels too high or too low.
And that is exactly where the internal foundation fractures most often, proving my point that price data alone is not enough. That ideal mechanical state you described, ignoring your entry price, is constantly undermined by a really powerful cognitive bias. The structural weakness in the mind here is anchoring bias. The brain grabs initial information, like the price you bought at, and holds it as an anchor. It's an irrelevant anchor, but it leads to terrible misjudgments. A new trader buys a stock at 100. It drops to 70. Do they look at the current price structure? No. They just think, I can't sell until it gets back to 100.
But again, that's a failure of execution, not a failure of the price reality. The price structure dictated a stop loss at 90, and the trader just failed to act.
It's a failure of the internal structure to process that reality without distortion. The anchor, that memory of $100, overrides the statistical anchor, which is your mechanical stop-loss rule. Anchoring is what makes people refuse to sell a loser until it gets back to break even. They're choosing ego over evidence. The only way to overcome this psychological weakness is to build your foundation on pre-commitment. You have to write down, before you enter the trade, the exact condition that proves you're wrong. This forces System 2 to engage before System 1 can take over. You're training your brain to value objective evidence over these subjective, memory-based anchors.
So we return to the source of all systematic success, the objective, unfiltered price signal. The incredible success and durability of the trend-following model, which relies solely on numerical market movement, I think it confirms that price is the true and sufficient reality for this. The structure is built around the data points, open, high, low, close, and the metrics we derive from them, like N.
And I would agree that price provides a system, but the essential foundation that the system has to rest on is the disciplined, statistics-oriented mind. Without continuous self-observation and the psychological engineering you need to manage perception under risk, those mechanical rules will fail. They will fail at the exact moment of peak uncertainty. The technical system is the engine, but the cognitive framework is the chassis that keeps it stable and the fuel that lets it run.
It seems we've shown that both a rigorous external rule set based on price and a robust internal structure are, well, they're both indispensable. True mastery, then, is probably the integration of the mechanical nature of price with the complex human interaction with that price.
Indeed.
You have to first know what you're seeing in the market, but fundamentally, you have to know why you're seeing it that way and how your own mind is going to process the unavoidable pain of probabilistic risk. The foundation is dual, but at the end of the day, the execution is singularly human.